Let's start with this weaker than expected GDP data that we saw this morning. What was your reaction to that?
Yeah, we weren't expecting a blowout number, but it was definitely a lot lower than we were expecting. So I think it does show the lag effect that is starting to be realized on higher interest rates. So we've been talking about higher interest rates now for, it feels like, over a year on a daily basis. And now I think it's hitting home builders, developers, consumers, and it's showing up in the numbers. So I think, when you correlate that to, foreign exchange, it probably, puts a lid on massive increases in the Canadian dollar. But more importantly, I would suspect the Canadian interest rate environment is going to flatline here, and they'll probably pause and watch the data for the next couple months, and we might be done the hikes. I'm not calling for major decreases in rates this year, but definitely it's positive if we're done the hiking path.
Okay, so a little bit more stability, perhaps. We have seen some volatility in the markets, a bit of a pullback as of late, but you're quite optimistic in stocks towards the end of the year.
Yeah, I think we'll get a good Q4. We're in this kind of a churning period here, July, August, September. The market's not super cheap generally, right? So price is not the factor here. I think what we're going to see is certain sectors play catch up, and really technology has been, and communications have been where everyone's made money this year. But I suspect you'll see healthcare and interest-sensitive names like utilities, REITs start to rebound at in Q4 and help bring the general market up with it.
With all that in mind, what would be your advice to investors?
Well, we're dividend investors at Middlefield, so taking that as a starting point, I think this is a really good time to be putting money into dividend-paying stocks. Inflation's coming down, interest rates over the next couple of years will moderate and probably come down, and that is really a tailwind for dividend-paying stocks that are increasing their dividend on a yearly basis. That helps you offset the inflation forces, but also gives you a really good entry point right now, because a lot of those names, I'll use utilities as an example, have performed quite poorly as rates were going up. So this is a really good entry point for dividend investors right now.
First off, we have an email here from Nelson, and he's asking for your comment on Cogeco Communications.
Sure. Cogeco is definitely cheap right now. We don't own it, but that whole space is looking attractive just because of how they should act as rates come down a little bit in 2024 and 25. So telcos and cable companies are facing lots of headwinds, but lower interest rates will help the sector. Our preferred names are BCE and TELUS, but Cogeco looks pretty interesting here on a valuation basis. So if you're looking to buy it, it's not one that we would shy away from. They seem to be struggling a little bit with their US. They've got some assets in Ohio, and I just see cord cutting happening at a quicker pace there. So, if you had a choice, I would start with BCE and TELUS, and then maybe Cogeco would be my third choice here.
Okay, and since you did mention BCE, we have to also say that that's our parent company here at BNN Bloomberg. Let's get another question in. This is Victor, and he wants to have your outlook for Fiera Capital. What is going on with the stock, he asks?
Yeah, so Fiera is an asset manager, mutual funds, ETFs, and they're seeing some outflows in certain areas of their business. They've done a lot of acquisitions to grow over the last decade, and they do have a lot of debt. So with higher interest rates, that interest expense is starting to nip them. Again, looking at that chart in front of us, it's really been hit here. So it's super cheap. But it's cheap for a reason, because the business is kind of moving sideways. It's not growing rapidly. And then also this debt burden. In this space, we prefer CI Financial, which is also cheap and is growing in the United States. And then also we prefer Guardian Capital. So there's two other asset managers that we have positions in, and we don't have one in Fiera.
Okay, that was good context. Let's go to the phone lines now, and here's a name I haven't talked to in a while. Taraver, calling in from Arizona. Welcome back to the call, Taraver.
Thank you. My question is on the Badger Infrastructure Solutions. That's an excavating company. Can you, Mr. Lauzon, talk about the business, and is it really a profitable business? I know the operating income has gone down over the years. And your thoughts, please. Thank you.
Yeah, you'll see Badger trucks, throughout the city, throughout North America, essentially, when they need to use water pressure to bore holes, as well as vacuum, sewers, things of that nature. It's a really good play on just the infrastructure rebuild that every aging city needs. We don't own it right now. I owned it, probably 5 to 10 years ago, but I just never revisited the story. They had some issues a few years back, but seemed to be getting over them. But in the infrastructure space, we prefer names that are towards electrification right now. So names like Eaton, for example, is how we're playing the infrastructure build out. Badger, I think, would be an ideal candidate. But again, we don't own it right now. I would recommend, Eaton if you're looking at just plain infrastructure in general, the spend.
And Rob, why are you focused more on companies with electrification as part of that?
Well, two reasons. One is the electrification of the grid needs to be updated. So we're plugging in more things. That is a growth area. And, the backlog for transformers, for example, is massive right now. And then second, kind of on the same theme is electric vehicles, and all of that is just another tailwind for stocks that are, whether you're bolting on electrical equipment to a solar farm, a wind farm, or the actual grid and cables need to be upgraded. Prysmian is a cable company in Europe that we own. They'll make massive cables. They produce them for offshore wind, for example, and to get the power back onto the land. That company seems to be doing quite well. I mentioned Eaton as well, but it's a real secular tailwind, is kind of the electrification of everything, and including the upgrading of the grid.
Okay, let's get one more caller in. This is Andre calling from Chilliwack, BC. Go ahead, Andre.
Oh, good morning, Tara. Thanks for taking my call. Mr. Lauzon, can I get your thoughts, please, on a rather hot stock as of late? They just reported Lululemon. It's 30 times. It's a little bit expensive for me, but my friend in Chilliwack has it. She'd like to know what to do with it. It's beat and it's raised its guidance. Your thoughts, please. The Chinese consumer has seemed to be all of a sudden buying this the stock. Could I get your thoughts? Thank you.
Yeah, it's been a great stock. It's been a great Canadian story. We don't own it currently. The main reason is most of our funds pay out high levels of dividends, so it isn't a high dividend stock. It continues to beat and raise. That is a recipe for good stock performance if management can continue to do that. They've got a real entrenched user base that loves the product. It's an innovative product. As you mentioned, in China, they are doing well and growing in other parts of the world. And you nailed it on the head. I think it trades around that 30-time forward earnings, which is probably the highest I would be willing to pay for a company like this. So, it's a tough call to buy it here. But if you're willing to kind of put it away for 2, 3, 4 years, the earnings momentum will continue. If it trades at 26 or 27 times earnings, it'll still be generally more expensive than other consumer good products. But the stock will be 10% lower. So maybe a wait for a bit of choppiness in the market to get into it, but it's a great story.
We'll get right back to the phone lines now, and we have Robin in London, Ontario. Go ahead, Robin.
Hi, Tara and Rob. Happy Friday.
Hi, Robin.
My question for Rob is about Gear Energy. Just wondering if something I should look at, or maybe I should go to another company in the industry. Thanks.
Yeah, Gear Energy is a little small for us. Generally, our broader dividend-paying funds that have energy exposure would buy mid caps or large caps. Stocks perform pretty good. It's heavy oil, pays a great dividend, so it's got a lot of the characteristics we like. Just for liquidity, we prefer names, and we really like energy right now. We are overweighted, but we're earning our dividends through, on the oil side, through Whitecap, who actually raised their dividend last night. So you're getting a pretty healthy, 6.5% dividend yield now with Whitecap. And then Headwater Exploration, HWX, is another one that we own for oil exposure, and again gives you a nice dividend and actually has pretty remarkable growth opportunities in the Clearwater. So I'm not going to say anything bad about gear. Just from liquidity, we would maybe advise you to look at Whitecap or Headwater.
All right. Now we have Bob calling from Newmarket, Ontario. Bob, what's your question? Bob, are you there? Okay, Rob, I know that he was going to be asking about BCE, which you'd gotten to a little bit earlier, but what are your thoughts on BCE more in depth?
Yeah, it's a slow growth business, and usually I wouldn't be very excited about the whole telco space. You're losing subscribers with cord cutting on TV. Really, the internet is the best area and for these companies. And in fact, BCE, in my opinion, has the best technology, the best internet, their fiber to the home. So that's the reason that we do like BCE. Mobile is very competitive, so it's really if they can continue to grow their internet, and the price is right finally, right? This was always a $60 to $65 stock. Because of interest rates, it's now in the $56, $55 range, which gives you a 7% yield. That's why I really like it here. We do expect interest rates to come down probably a couple times in 24 and a couple times in 2025. And just having interest rates at the short end of the curve come down 100 basis points or 125 basis points over the next couple of years will probably get this dividend back in the 6 range. So you've got a 7% dividend plus probably 5 to 10% upside in the stock when that happens. And that's a pretty good return for long-term investors. 12%, 13% over the next 12, 13 months is attractive to us. So if you're that type of an investor, this is an interesting time to enter the telcos here.
Okay, and again, the disclosure is that, of course, Bell BCE is our parent company here at BNN Bloomberg. Let's get to another caller now, and we have Daniel calling from Markham, Ontario. Daniel?
Hi, Tara. Hi, Rob. May I have your thoughts on MEG Energy? Is this a good time to buy Canadian oil stocks? Thank you for taking my call today.
Thanks. Good to hear from you. Yeah, we do like MEG. It doesn't pay a dividend, but it is buying back a lot of its shares. It's breaking out here above $25. I haven't seen it at that price in quite a long time. It is an oil sands long life asset. Doesn't require a lot of CapEx, so it's a very valuable asset. They also have a lot of tax pools that are also valuable. So if you've got a long-term positive view that the Saudis are incented to keep oil above $70, $75, this stock will continue to work. Who knows? I know they're trying to pay down debt to a certain level, and then at that point, we'll probably buy more stock or even increase or initiate a dividend. We're probably a year away there, but yeah, it's a great company, and could be an acquisition target for another company that's looking to get long life barrels. Again, if you prefer dividends with your oil exposure, I mentioned Headwater and Whitecap, but we would also recommend MEG if you're bullish on oil.
Okay, next up we have David calling from here in Calgary. Go ahead, David, with your question for Rob.
Good morning. Thanks for taking my call. I'm just inquiring about Nexus Industrial REIT. See where it's going for long term. It seems to be lost a little bit of money as of late. I wonder what your opinion is going forward. Thank you. Yeah,
it's in the industrial real estate space, a space that we really like. So when you think about this space, this is really the buildings that you see around the airport, for example, right? A FedEx building or a food warehouse or storage for warehousing. The stock, one reason the stock's down is just all REITs have a bit of a shadow over them, which we think is a very good buying opportunity right now. So we're very bullish on REITs. But because of the narrative on office and how it's cast a shadow on all real estate, whether it's apartments, whether it's industrial like Nexus. So you've got an opportunity to buy areas like industrial REITs, multifamily or apartment REITs. And Nexus also has a little bit too much debt, in our opinion. That's another reason why it's sold off. And they grow by acquisition. They constantly, raise money, raise equity, buy new assets into the REIT. So, if we had a pecking order for industrial, I would put this third. I would say Granite and Dream Industrial would be my top two areas to look at, and then I would look at Nexus. So that's those would be my general comments there.
Welcome back. Now it's time for Rob Lauzon's past picks. So these were your picks, Rob, back on September 12th, 2022. And let's start with Granite REIT. At the time, it was $77.19. Now $75.47. So with all involved, total return came in at a positive 2%.
Yeah, it's nice to get that dividend to keep you positive. We just mentioned Nexus REIT, so this is in a similar area. I mentioned we still very much like it, and I would, it being flat over the year versus that Nexus chart. I think Nexus would look like it was down about 10 or 15%. So Granite's done well. We think it's probably an $85 stock sometime in 2024. Plus, you get a growing dividend as well. So we really like it here, and would continue to recommend holding it and buying more.
Okay. Next up, we have TransAlta. At the time, it was $12.37. Now $12.98. So total return 7% on this name.
Yeah, it's in the utility space, which has struggled. So the fact that it's up 7%, it has outperformed a lot of its peers. It's doing quite well. It produces power in Alberta, where you're sitting, and power prices are quite high there, so they're benefiting from a lot of free cash flow. There's a little bit of noise in the stock right now because they're rolling up a subsidiary called TransAlta Renewables. So they'll be buying that into the company. And once that's done, I suspect management will, provide some pretty good guidance going forward. Hopefully keep increasing the dividend. I think it needs to go up a little bit higher as well. So all in all, we really like TransAlta. It's too cheap. We think it's a $15 or $16 stock. We've owned it for a while and would continue to own it and buy it here at the $13 level.
Okay, another one that you'd recommend. Let's go to the last one. This one had a bit more of a rocky road. This is Tidewater Midstream. At the time, $1.26, now $1.07. So a total loss here of about 11%.
Yeah, so Tidewater management, the CEO left about probably 2 months after I recommended this, or 1 month after, so it was kind of an unfortunate timing on my part. It seems to have found its footing. New management is really doing a strategic review of the company. This week it sold some assets to AltaGas at a really decent price, which we liked. And management will be using that proceeds to pay down debt. You can see the stock acting pretty good this week based on that. Again, there's a subsidiary here, Tidewater Renewables, LCFS, that's really going to be the next catalyst for the stock. We still own it, and we think Tidewater will do well once LCFS gets commissioning done on its renewable diesel facility. Once that is in place and we start to see EBITDA on renewable diesel from that facility over the next 6 months, I think both stocks act a lot better. So I would continue to look at Tidewater if you're interested in a small cap midstream company. Its comparables would be Keyera, names like that, which we also own, but this is just a smaller version of a Keyera.
All right. Well, thanks so much for that. We'll be right back with Rob Lauzon. He is Chief Investment Officer at Middlefield Capital Corporation, taking your stocks this morning on global and North American equities. Stay with us. We're going to head right back to the phone lines now, and we have Joe in Montreal. Joe?
Yes, hi. I wanted to ask your guest about telecommunications. I'm down about 20%, and I know it's because of the higher interest rates, and I understand they've been brought down by their international unit. And would this be a good time to add on to it, or does he think we should wait in case we have another increase in the interest rates? And if the international group still doesn't help their earnings and performance? Thank you.
Yeah, thanks for the call. Yeah, we've been talking a few calls now on the telcos. I think that's good. Like, it's not the most, it's not the highest growth area in the stock market, but for investors that are looking to get dividends, this is a really good entry point. The question, Tara, that you asked at the beginning, just on GDP in Canada, like, I think given that sloppy number this morning shows that we're probably not going to see rate hikes. So, when you look at names like TELUS, BCE, some of the REITs today, you'll see them starting to form a base. And, I think, TELUS gets you a good dividend. So, I think in a broad portfolio, I would encourage you to average down here. You're down 20%. TELUS International, they've done layoffs, and that provides some growth for TELUS. So we like it. So I think it's a really good time today, given that GDP print that we probably don't see any more hikes. This is a really good time to average down for yourself.
Let's get to Louis in Montreal. Go ahead, Louis.
Thank you, Tara. Hi, Rob. My question, I'd like to know, Rob, you just mentioned a few minutes ago that you do like Whitecap and Headwater. But my question is, do you like Peyto Exploration, a stock that has a very high dividend yield? And if not, which other stock paying like 8+ in the energy field, Canadian energy field, stocks would you prefer? Thank you.
Yeah, so coincidentally, I haven't mentioned Peyto because we haven't talked about natural gas. So we've talked about oil. I like natural gas, and in fact, we've been buying Peyto over the last few weeks, and it's a stock that we've owned for off and on for decades when we're bullish on natural gas. If you look at the forward curve on gas, the 24 and 2025 prices are quite robust, and Peyto can hedge out and bring in some safety into their dividend model. I think that 10% dividend yield that they have is safe, and that's a main reason that we're buying the stock, based off gas prices that I see, and they have a very prudent dividend hedging policy. They do a monthly update on their website. You get good transparent information from the company. So, we might trade out of it if we think gas in a couple of years comes down. But, the way Canada is going to start to export LNG, we've got good volumes of natural gas happening here in Canada. The price, we have, exporting our natural gas really gives another buyer, so more demand for Canadian gas, which should help prices. So we like Peyto here. Another high dividend yielder would be Topaz, Freehold. Those are other names that you can look at as well. Tourmaline pays out special dividends, so when you include those, you get close to a 7% yield on Tourmaline as well.
Let's get another caller in. This is Linda calling from Edmonton. Go ahead, Linda.
Oh, thanks so much for taking my call. I am trying to increase my Asian exposure. Recently, I bought Uber, and now I'm wondering if Visa would be a good buy for the Asian exposure, or if you'd recommend some other stock.
Sure. Yeah, I like the way that you're thinking about it. Not buying a Chinese listed name or an Asian listed name. You can buy multinational companies. There is a top pick today of mine that does business in Asia, so you can tune in for that in the healthcare field. But when you're buying names like your travel businesses, but like Visa and MasterCard are great global businesses. Everywhere you go, you can use it. They got out of the limelight 2 years ago when everyone was, payments was everything about Square and PayPal, but now everyone realizes the railroads of the sky that Visa and MasterCard provides. Every time you tap, data is sent. They are really payments, and so that's a good idea. Disney's been beaten up here. That's a bit of an exposure with theme parks in Asia. And then just, any kind of global brand like an LVMH and Nike, other ways of playing that. And then generally commodities. Like if you think Asia is going to bounce back with demand, all commodities, copper, oil, natural gas, uranium, they should all, have a strong bid. So a little more volatile and risky with commodities, but those are some ideas for you.
And I like the promo to your top picks coming up at the end of the show. Let's get another couple callers in here, and we have Keith calling from Brampton. Keith, what's your question for Rob?
Thanks for taking my call. My question's on Tamarack Valley. It seems to be lagging the pack. Can I get your thoughts, Rob? Thank you.
Yeah, there's some questions just on, a few of their drill results and just how much acreage and land they have in the Clearwater that can continue to grow the company. There's nothing wrong with Tamarack. In fact, when we have owned it in the past, but I switched most of my Tamarack into Headwater about a year ago. Same location. I just feel Headwater, just has, the complete package with where I want the acreage to be, plus the dividend growth. So there's nothing wrong with Tamarack. We're overweight energy. We probably have about 10 names in one of my portfolios. And 3% in each of them gives you 30%. I just can't own them all, right? So, nothing wrong with Tamarack, Gear, other names that have been mentioned today, but we pick our horses. So, we prefer Clearwater over Tamarack, or Headwater over Tamarack.
Let's squeeze in one more here. Oh, right, sorry. Yeah. Mitch in Sudbury's got the last question here for you, Rob. Mitch, go ahead.
Hi, Rob. This is my first time calling. The question is about Source Energy Service, ticker symbol SHLE. It's very volatile.
Yeah.
Is it a buy or a hold? And why is it so up and down? Thank you.
Yeah, thanks for calling in. Hope to hear from you more often. Source Energy, these small cap energy service companies, so the frackers or the names that provide fluids, really get out of favor. And then when they get into favor, they'll have massive, like 30%, 40% rallies when energy's in favor. But when they're out of favor, no one wants them. And they trade at pretty poor multiples because they are quite volatile. It's the first thing, if oil prices or gas prices come down, the first thing a company's going to do is drop spending, and which results in very volatile earnings. We like the cycle right now in energy. So owning Source, the small cap now, this is the window to own it. How we play this side of things, we would pick larger companies. Trican, Precision Drilling would be the two names that we would choose over it, just for liquidity. But hopefully that gives you some guidance of why it's so volatile. It's really, has volatile earnings based on the cycle, and it's a small cap.
Next, we have William calling from London. William, what's your question for Rob?
Good afternoon. I've done very well with your suggestions. Thank you very much. I'm just wondering what your opinion would be to buy more Topaz, please.
Yeah, we really like Topaz here. I think it's around the $21, $22 level. It's, hitting their numbers. It's got a very strong runway of growth because their royalties are primarily on lands of Tourmaline and Headwater that are growing themselves. So it's a royalty company. We would continue to buy this stock as a lower volatility way to get energy exposure and get a great growing dividend.
Okay, now let's head over to Vaughan, Ontario, and we have Henry on the line. Henry, what's your question?
What's your opinion of Pembina Pipeline for a long-term hold with a good dividend? Thank you.
Yeah, it's a great entry point for Pembina. All of the energy infrastructure names in Canada have pulled back primarily because of interest rates. So there's a 10% move down in all of these stocks that I can attribute to that. One of my top picks is in this space today, which we'll talk about later, but the reason Pembina has sold off, it was in the $50 range. The other reason, besides interest rates, is that there is chatter that they may be one of the buyers for the Trans Mountain pipeline that the government is building. So that will be a lot of, either debt, shares, equity raise, so we need to get clarity on that. But I think the way you described a long-term entry point, a long-term hold, this is a good time to get into the whole energy infrastructure space. And we do own Pembina, and would encourage you to buy some.
And you had another promo for top picks. You're doing my job for me. This is great. Let's stay with the callers for now, though. We have Nichelle calling from Canada, Ontario. Go ahead.
Taking my call. I would like your opinion on Nutrient. I was in it, got out a bit last year at about 120 and looking at a good spot to get back into it.
Yeah, the stock's really been hit. It trades with fertilizer prices. Fertilizer prices spiked when the Ukraine war started, and then now that European gas prices have come down, which is an input for nitrogen, generally over the last 6 months, CF Industries, Nutrien have all pulled back. They formed a bottom in the early part of the summer, and we've been accumulating shares of Nutrien. So I would recommend for you to continue to look at adding it. I have no problem with that. And the positive is Nutrien is a little less volatile than some of its peers because they do have a retail network of stores that they sell things to farmers, which gives it a good, base of earnings to start each quarter. And then you tack on the fertilizer prices, potash, nitrogen. So all in all, definitely in the $80 range is where we've been picking away at stock.
So you would prefer Nutrien to, say, Mosaic, just given the wider breadth of its services?
Yeah, we own CF Industries and Nutrien as our main two ways. Mosaic would be the third after those two. So if you're building a portfolio, you could buy all three. But if you're just picking one, either CF Industries or Nutrien would be our top two ideas.
Gotcha. All right, let's get back to the phone lines. We have Alan calling from Montreal. Alan, what's your question for Rob? Okay, Alan was going to be asking you about Power Corp. What are your thoughts on Power Corp?
Yeah, it's Power Corp's a conglomerate, essentially owns, within it, Mackenzie Investors Group, Great-West Life. So instead of owning the conglomerate, we own a life insurance company. We own Manulife and Sun Life. And then on the asset managers, we own CI Funds, as I mentioned earlier, and Guardian Capital. So we've kind of, we own what Power Corp owns that way. Anytime it's below $40, it trades at about a 20% discount to its NAV, which represents a good entry point. So I wouldn't dissuade you from buying it here. We just kind of play the same sector through different names, but it's got good brands, and if rates do pull back, you'll have more money going into the financials over 2024. So it should have a better 2024.
Okay, let's head over now to Saskatoon, and we've got Nigel on the line. Nigel, what's your question?
Hi, great show as usual. Can I get your thoughts on Paramount Resources? I believe they're 47% inside ownership, debt-free, own just under 20% of NuVista, and also investments in Westbrick. I'll hang up and listen. Thanks.
Yeah, Paramount is almost like a conglomerate of an energy company because it actually has its own drilling and service rig business. So you get a lot with Paramount. Like you said, they sold off some acreage and paid down their debt. So we've been accumulating. One of our portfolio managers, the symbol is POU in Toronto. So one of our portfolio managers has actually been adding to it recently. We definitely, having management have skin in the game, Tourmaline, Paramount, those type of companies that they have a lot of insider ownership, gets you aligned with management. So that's a good tailwind. So we would recommend accumulating POU here.
All right. You know what? We do have an email right now. It's come in. This is from Augie, and he wants to know what you think about Union Pacific for the short and long terms compared to the other major railroads.
Yeah, we own Union Pacific. We've owned it for a long time as just a steady Eddie way of getting exposure to the U.S. economy, essentially. I really like it now because they've brought in former management, a former COO of the company is now running the firm. I think that was announced a couple weeks ago. They had a tough quarter because freight and logistics volumes have pulled back from the highs during COVID. But this is a really good entry point. I think with the new management being very focused on squeezing higher margins, this will drive earnings per share a lot faster than the market is expecting. And I think the stock probably will hit highs in 2024 or early 25. So I do like it here. Go ahead and accumulate.
Go ahead and accumulate. You know, what do you think about CN and CP, just sticking with the railways as well?
Yeah, you know, they're all good businesses. You know, we own them. We have such low cost bases because they just continue to give you that pulse of the GDP. We own CN Rail currently, and you know, those two give you a little more exposure to what's happening in Canada as well as the United States. But the whole CN, or the whole railway business, I think, has bottomed. It had a tough start to this year, but I think, you know, if you wanted to stay in Canada, didn't want to buy the U.S. currency with Union Pacific, you know, owning CP or CN is, and as you can see, CN's lagged, so that might be the choice right now over CP.
And now it's time for his top picks. So let's get to the first one right away here. This is Chartwell Retirement Residences. Why did you choose this one?
Yeah, we've got a strong franchise at Middlefield, both real estate ETFs and mutual funds. So we've been in the REIT space for over 20 years. And when we looked at earnings estimates going into 24 and cash flow estimates, Chartwell actually screened as having one of the highest growth rates expected earnings. And so typically stock prices will follow if you're growing at a rapid pace. The reason for that is they're starting to see occupancy trends increase. So a lot of people came out of retirement homes during COVID and now are feeling a lot more comfortable to go back. So if they can get occupancy back to where it was pre-COVID in that 85 to 90% range, you know, all of that extra revenue basically falls to the bottom line and helps their margins. So, you know, we think where it's trading at a, you know, 80% or like a 20% discount to NAV is too punitive, and you know, we think it's probably a 12 to 12.50 stock, $12 sometime in 2024. So I really like the entry point here.
Okay, this next name you'd kind of alluded to when we were talking about access and at least exposure to the Asian markets. This is Medtronic, and why did you choose this one?
Yeah, we really like med tech. So in healthcare, in our healthcare funds, you know, we often have a barbell strategy between pharma companies and then med tech, and we're really excited about med tech because again, surgeries, all of that was shelved during COVID. They're starting to come back, and you can see the share prices, you know, all dropped 20, 30% during COVID. So things are stabilizing. You know, they do insulin pumps. They've got robotic technology for surgeries and pacemakers for your heart. So, you know, we think the low is in on Medtronic, and it does sell a lot into Asia. So there's a way to get some exposure there. It's trades 16 or 17 times earnings forward, and it should trade at 20 times. So I think there's 25% upside in this name over the next 12 months.
And I suppose both of these last names, Medtronic as well as Chartwell, are also getting a lift from the aging population as well.
Yeah, that's just a natural demographic tailwind that will help both companies over the next 5 to 10 years for sure.
Okay, let's get to your last top pick, and this is the one that you promoted when we were talking about Pembina pipelines, but Enbridge would be your top pick here.
Yeah, I just looking at their history of growing their dividend every single year, so expect another dividend bump. I think they usually bump it in January or February, but it's yielding over 7%. And look what that chart is, just basically what interest rates have done to the stock. And I think once we see interest rate cuts, we'll get a few, in our opinion, next year by the Bank of Canada and a few more in 25. The stock will be back to $52. So, if you can lock in a 7 yield and 8 to 10% upside in the stock over the next year, that's a pretty good total return. So I think it's a really low risk way of playing in energy infrastructure. And again, because we like dividends so much, a 7% dividend yield that's tax efficient for Canadian investors is quite attractive.
Just even thinking about pipelines and the difficulty in getting new infrastructure into the ground, as we've seen even with the Trans Mountain expansion, why would you choose Enbridge, say, over Pembina or TC Energy and all the other players that are in this space?
I really like Enbridge's thematic on the energy evolution or transition. So they've got technology in carbon capture, they're involved in LNG, they're involved in hydrogen. Like, they'll be able to move carbon and hydrogen through their similar pipes that they have in the ground now, over the next 20 years. So, they're going to be part of that energy transition. I really like that thematic as like an added growth area on top of their base business.